Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment, we have Ted Koenig. He's the president and CEO of Monroe Capital, a boutique asset management firm specializing in private credit markets across various strategies, including direct lending, asset-based lending, specialty finance, opportunistic and structured credit, as well as equity. Ted, it's great to have you with us. Welcome to Trade Talks.
Thanks, Jill. Nice to be here.
All right, let's talk about inflation. Do you think the risk here is being underestimated?
No, short answer. One of my predictions earlier in the year, about 6 months ago, was that the economists and the politicians and the smart guys didn't get it. That we were going to see big time inflation end of year 21 and into 22. And it's wages, it's supply chain shortages, it's commodities, it's oil, everything is up. And, we're seeing a 6% inflation rate, but that's on the surface. It's really 10% when you look at it below that. And wages is driving it.
Right. Well, let's talk about deal flow. That's one area of the market that's been especially strong. What is that being driven by, and do you think it's sustainable?
Uh, 2021 is the highest level of deal flow we've seen in 20 years doing this business. And it's kind of a combination of a lot of things. We've got the greatest, highest PE valuation in the public markets right now, about 21 and a half. We've got a lot of discussions about tax changes. We've got record numbers of dry powder in PE and in private credit. So we've almost got a perfect storm of the need for middle market companies to sell and for large cap companies to grow earnings. And they can't do it internally. The only way to do it is externally and to grow that way. So our financing, we've done 100 deals this year in 21, just to give you some perspective. Usually we'll do anywhere from 50 to 60 deals in a year. So 21's been a normal year.
Yeah, you have been busy. So Ted, the question is, what, if anything, could potentially impact M&A and middle market activity?
One thing will be taxation. I think people are trying to get under the bell. This year there's been a lot of talk about increasing capital gains rates, increasing income tax rates. So a lot of the transactions were tax motivated. Another thing that we see next year is more inflation. Could slow the deal flow business down. And this whole two double punch issues, I think, are COVID, which is uncertainty in this new variant, Omicron variant. And number two is politics, good old fashioned politics. I mean, we've got a dysfunctional group of people in Washington right now, and they can't agree on what day it is, let alone whether to raise the debt ceiling or whether to pass the infrastructure bill. There's all kinds of crazy things that could happen, and I never thought that U.S. politics would be a risk as opposed to a benefit.
Right. Well, that's a great point that you make there. Usually we're talking about geopolitics. It really is kind of surreal to be talking about what's happening domestically. Ted, let me pick your brain. Anything that you're seeing in terms of lending trends?
Yes, some areas that are hot that are going to continue to be hot. And what's interesting, if you follow lending, that'll generally let you follow PE, which generally takes you to the stock market. And those are hot areas. So I think healthcare will continue to be a hot area for lending. We're seeing a lot of behavioral type lending going on in healthcare. These are anorexia, eating disorder, pain management, sleep disorder, all different types of facilities, waiting lists that I've not seen before, 9 months, a year waiting lists to get into weight loss clinics or to some type of eating disorder clinics. That's one area. I think you'll continue to see dermatology. That's been a great growth area, consolidation play. Right now, the challenge is with supply chain. It's really tough because you don't know if the demand is pent up right now, or it's because we don't have supplies. But right now, commodities, steel, aluminum, copper, we're having a hard time getting those things into companies' hands, which means that the auto industry is troubled. We've got supply chain lines shut down. We like to see areas. Fintech has been growing quite a bit. A lot of finance is going to the consumer. Consumers are leaving banks and going into alternate finance vehicles. So I think those are key areas. And then biotech is always on the cusp of doing something great. The problem is like throwing darts. Of the 1,000 biotech companies out there, 25 are going to be successful and win, and lots aren't. And that's the challenge.
Well, Ted, we brought up the supply chain a couple of times during this interview. Use your crystal ball. Does this get resolved in 2022? Is this an 18-month, 2-year thing?
I think it's a 22 issue. I think the first half of the year, we're still going to see some challenges, but it's going to abate. As consumer demand abates a little bit, you'll see that, and we'll fix it. It's not really a question that there isn't product. COVID hurt us a little bit in the global supply chain with, employees, manufacturing facilities were shut down, here just as they were in Asia. So that's coming back online now. We've had a challenge with container ships, containers. That's getting itself sorted out. I think we'll see it probably towards the end of second quarter start to normalize.
Right. Well, I mean, if you think about the timing as well, the demand has certainly been there for goods, right? Which is why we have this bottleneck, but we necessarily haven't seen the same demand when it comes to experiences or services, things that don't require physical goods. So, assuming the world gets back to some sort of normal and we get this virus under control, in theory, the end of second quarter and the last half of the year, we should see the demand for experiences and service again.
It will, and that's a great point. The second half of this year has been consumer-driven demand that's been driving the economy. Products, services. I mean, think about it. There were no elective surgeries for almost 9 months. People couldn't see dentists for 6 months. Dermatologists, ophthalmologists. We had whole industries of services shut down. You couldn't go to these health fitness studios, whether it was LA Fitness or whether it was Orange Theory or Pure Bar or Bar Method. A lot of people couldn't work out, so they were modifying their behavior in their own homes. Now that's opened up again. We're starting to see that. We're starting to see the hotel industry, start to make a comeback. The cruise industry, gambling. I mean, a large part of our economy, 60% of our economy is service related, and that employs 70% of all employed people in the US in the service industry. So think about what that means if you're a 12 months or 18 months out and you can't go to these things. So I think we're going to start to see normalization. And the only big caveat, as I said earlier, is COVID. I think that as the nation gets vaccinated, we're already 50%. Unfortunately, this has turned into a freedom of expression and political issue as opposed to a medical issue. If we'd all just suck it up and understand it's a medical issue, I mean, we'd be home free. But unfortunately, we don't think that way, and that's the challenge.
All right, Ted, appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.